Welcome to this explainer. Listen, if you've ever felt completely overwhelmed staring at a messy, chaotic trading screen, you are absolutely in the right place. Today, we're diving deep into the source material to demystify moving averages once and for all. And we're going to unpack the exact mechanics behind a hugely popular, highly profitable scalping strategy.
Okay, so let's just get right into it. We have all been there, right? You open up a trading chart, and honestly, it looks like someone threw a bowl of colorful spaghetti right at your screen. You've got a yellow line over here, a white line there, a green one, a purple one. It's incredibly confusing. Especially if you're a beginner, it kind of feels like you need a PhD in finance just to read the thing. But what if I told you that you really don't need 50 different indicators to be profitable? What if you could strip away all of that noise and rely on just two simple, rule-based lines to tell you exactly when to buy and when to sell? Well, that is exactly the power of mastering the moving average.
Here is our roadmap for today. We're going to start by decoding the moving average, then look at why the EMA beats the SMA, jump into the crossover strategy, master the art of scalping, perfect your trade entries, and finally uncover the ultimate index correlation rule.
All right, kicking things off with Section 1, decoding moving averages. What actually is it?
To truly grasp this concept, let's just forget about stock prices for a second. Imagine there are 10 people in a room. If I ask you for their average weight, you just add up their individual weights. Say someone is 70 kilos, someone's 80, maybe someone else is 75. You divide that total by 10, and boom, you find the average is exactly 75 kilos. A moving average on a stock chart does the exact same thing. It just uses the closing prices of candlesticks over a set period of time. And as new candles form, the oldest ones just get dropped from the calculation. So the average literally moves forward right along with the current data.
And you know, this brilliantly illustrates the core psychology of the market. Think back to that average weight of 75 kilos. If a person's weight temporarily drops down to 70 or spikes up to 80, what usually happens over time? Their body tries to return to its baseline, right? To its average. Well, stock prices behave the exact same way. Price always tries to return to its average. When a stock's price strays way too far from that moving average line, it acts like a giant rubber band, eventually snapping right back. And because of this, that moving average line acts as a super powerful dynamic magnet for both support and resistance.
Moving right along to Section 2, why the EMA beats the SMA when it comes to speed and responsiveness. So there's a really distinct difference in how these two calculate their data. The simple moving average, or SMA, treats every single data point equally. So if you're looking at a 200-period SMA, whatever happened 200 candles ago is given the exact same level of importance as what happened literally 5 minutes ago. But actually, think about the real world here. Does a massive market crash from 200 days ago, like that insane volatility we saw during the early days of COVID-19, does that matter as much to a day trader as the price action happening right this second? Absolutely not. No way. That is exactly why active traders heavily prefer the EMA, the exponential moving average. The EMA mathematically assigns a much higher weight to the most recent price action, which just makes it way more responsive and accurate for fast-paced trading.
That brings us to Section 3, the EMA crossover strategy, and how to get actual actionable signals.
See, traders don't usually just use one moving average. They pair them up based on their goals. If you're an intraday trader looking for quick moves, you're going to want a tight pairing. The 7 EMA is your fast line, and the 21 EMA is your slow line. Now, if you're a long-term investor, you simplify the whole shebang. You just pull up a daily chart and plot the 50 EMA. And the golden rule for investors? You only ever buy a stock if the price is trading above that 50 EMA. If it's below it, you don't even touch it. Finally, for major long-term market trends, investors look for what's called the golden cross, and that's where the 50 EMA interacts with the 200 EMA.
So, the crucial point here is how you actually read the interaction between these two lines for intraday trading. Using that 7 and 21 EMA configuration, the 7 is your fast line because it reacts quicker to price changes, and the 21 is your slow line. The rule is brilliantly simple. When the fast 7 line crosses the slow 21 line from below and it's heading upwards, that generates a crystal clear buy signal. Conversely, when that fast 7 line crosses the slow 21 line from above, heading downwards, it gives you a sell signal. It completely takes the emotion out of your trading.
Okay, let's level up. Section 4, mastering scalping for quick, regular profits.
Before we even set up the chart, let's define our game plan. Scalping is a highly specialized trading style. You're not holding a stock for days or weeks here. You're holding a trade for minutes, sometimes literally seconds. The goal is to profit off very small price changes to earn quick, regular profits.
And honestly, this is the absolute ideal strategy for retail traders who might have a smaller starting capital. Why? Well, because the market spends 80 to 90% of its time just moving sideways in a choppy range, which completely eats traditional intraday traders alive. Scalpers, on the other hand, just wait for brief, explosive moments of momentum. Get in, take their profit, and get out before the market flatlines again.
For this specific scalping strategy, we are throwing out the 7 and 21. Instead, we're going to apply a 9 EMA and a 15 EMA to our chart, and we are setting our time frame strictly to 5 minutes, no exceptions. The 9 is our new fast line, and the 15 is our slow line.
And this brings us to the absolute non-negotiable golden rule, the 30-degree threshold. If your EMA lines are flat, just kind of moving horizontally across the screen, you do not trade. A flat EMA means a sideways market, and a sideways market is going to trigger fake signals and absolutely destroy your capital. You've got to wait for those EMA lines to angle upwards or downwards at a slope of 30 degrees or steeper from the horizontal plane. That 30-degree angle, that is your ultimate confirmation that real momentum and a true trend are actually happening.
Which leads us perfectly into Section 5, perfecting your trade entries. Exactly when to pull the trigger.
Look, even with a 30-degree slope, you never just buy blindly. You are always hunting for one of 3 specific confirmation candles that are actively interacting with your EMA lines. First up, a pin bar candle. That's a candle with a very long wick at the bottom, which shows that price was pushed down, but buyers aggressively rejected it and pushed it right back up. Second, a big body candle. A strong, full green or red candle showing absolute dominance by either buyers or sellers. And third, an engulfing candle. That's a candle whose body completely covers the previous one, signaling a massive shift in momentum. You absolutely must spot one of these 3 candles touching or crossing the EMA before you ever even consider entering the trade. So let's build this into a strict 4-step execution playbook. Step 1. You look at the chart and you confirm your 9 and 15 EMA lines have a slope greater than 30 degrees. Step 2. You do not chase the price. You wait patiently for the price to pull back or retrace and physically touch your EMA lines. Step 3. Right there at the EMA line, you look for your confirmation candle, a pin bar, a big body, or an engulfing candle. And finally, step 4. The second that confirmation candle closes, you enter your trade on the very next candle. And immediately, you place your stop loss just below the low of your confirmation candle.
Now, because you're entering right at the EMA with your stop loss placed just below the entry candle, your risk is incredibly small. This allows us to easily target a 1-to-2 risk-to-reward ratio, meaning for every single dollar you risk, you are aiming to make $2 in profit. This tight stop loss is just fantastic for your trading psychology. It prevents those massive account-ruining losses, keeps your heart rate down, and allows you to stay calm and objective because you know your downside is strictly capped.
When you're executing a scalp, how you handle options contracts is critical. You must always trade in the money or at the money contracts. Never ever buy cheap out of the money options. Why? Because of a little thing called delta, which is essentially the speed at which the option's price reacts to the actual stock. An at-the-money option has a much faster reaction speed, with a delta of about 0.5, and in the money is even higher, around 0.6. This means if the underlying index moves 100 points, your option is going to move a fast 50 to 60 points. Cheap options just won't move fast enough to capture the scalp, and time decay is going to eat your profits alive. To do this properly without ruining your trading psychology, you really should have a minimum starting capital of $25,000 to $30,000 to comfortably manage these in-the-money premiums.
Finally, Section 6. This is the big one, the index correlation rule, your ultimate risk management secret.
If you take away just one execution habit from this entire explainer, please make it this. Never trade a major index like Nifty without having its financial counterpart, Bank Nifty, open directly beside it. You absolutely need a dual screen setup, or at least a split screen, watching both of them simultaneously. If you try to scalp Nifty in total isolation, ignoring what Bank Nifty is doing, your accuracy is going to plummet and you will get faked out constantly.
And this brilliantly illustrates exactly why they have to be paired. Listen to the synthesized golden rule straight from the source material. Never buy Nifty if Bank Nifty is trading at resistance. Never short Nifty if Bank Nifty is at support. Let's say you get a perfect 915 EMA buy signal on Nifty. It looks flawless. But you glance over at Bank Nifty, and it is hitting a massive ceiling of major resistance. You have to cancel the trade. Bank Nifty's rejection at resistance will pull Nifty down right along with it, turning your perfect setup into a losing trade.
However, when both indexes actually confirm each other, when Nifty gives a buy signal and Bank Nifty is bouncing off strong support at the same time, your win probability skyrockets to nearly 90%.
We have covered some truly incredible ground today. You now have the exact rule-based playbook to clear away all that chart confusion, identify real momentum using the 30-degree rule, execute precise entries with a 1-to-2 risk-to-reward ratio, and protect yourself using index correlation. So, my final question to you is this. Instead of jumping in blindly, are you ready to open up your trading software, pull up the 9 and 15 EMAs, and actually backtest this strategy on historical charts today? The rules are laid out for you. Now it's time to see the data for yourself. Thanks for joining me on this explainer, and